Lovely. Item 3, minutes of the previous meeting. Are you happy that I sign them as a true and accurate record? Yeah. Thank you. And we'll move straight into item 4 then, please. So if I can pass on to our Director of Finance and Procurement, Mike Ray.
Thank you, Chair. Members will recall Forvis Mazars presented their draft audit strategy memorandum for the audit of the 24-25 statement of accounts to members at the Audit Committee in June. Karen Murray, Audit Partner for Forvis Mazars, is here today to take members through the updated audit strategy memorandum attached as Appendix A to the report. Over to you, Karen.
Thank you. There are a few changes to the report that we presented today from the one that you received at the last meeting. They are primarily cosmetic, I guess, with one exception, which is there's a new identify significant risk in there. So the first thing just to mention is that we've had a change in our team members. So we've got a new assistant manager who'll be working alongside Katie, who was at the last meeting as our audit manager. That's just to help us to manage some of our workload and the clearing the local government backlog and the work that we need to do in the sequencing. So it helps us to fit your audit in. As a consequence of changing team members, we have adjusted the timing slightly from that which you received in the last version of this report. But I think worth noting that the deadline for the backstop for this financial year, the 24-25 financial year, is actually the 27th of February 2026. And it is my expectation that your audit will be complete before Christmas. So well in advance of that deadline, and obviously we'll report back to you at an appropriate audit committee thereafter. The other thing that's changed in here, we received your draft accounts at the end of June, so after your last meeting, in line with the statutory timetable. And as a consequence of receiving your accounts, we've been able to reassess materiality. So your expenditure's increased. We set materiality based on expenditure because we know that that's what taxpayers are interested in, if you like. They want to know where their money is going. So there's been a slight increase in your materiality. It's not significant, it's just the levels that we will work to. Nothing else has changed there. But the other thing that has changed from the draft plan is that we have a new significant risk in your accounts. You'll recall that a significant risk is one where we believe there is a risk that the accounts, if they're wrong, would be materially wrong. It's in respect of your lease accounting because there's been a change in the accounting standard. Originally, we were expecting the amount to be, and indeed it is in your accounts, immaterial, but we're not sure, we're not confident that that calculation's right. So we're talking to your finance team and we've identified it as a risk because we think it's possible it will change and potentially by a material value between now and when I sign the accounts at the end of the process. So that's really all I wanted to say about the plan. The plan does set out for you the work that we plan to do in response to significant risk, but I wasn't going to bore you with the technicalities around auditing these disclosures. What I do want to say though is that our work is actually well underway in terms of audit delivery. So your team have already been incredibly helpful to us. We've given them all of the items, or most of the items that we want to test, where we're doing sample testing, which is giving the team the opportunity to go out to different parts of the service to get responses to those sample items, provide the evidence to us, so that when we come back in to start our audit in earnest, if you like, in 2 weeks' time, the information will be ready for us and we'll be able to just pick it up and tick through it, hopefully fairly quickly. Doing it that way does actually mean that if there are any issues where your team's struggling with evidence or because we get through it a little bit quicker, we've got plenty of time then to resolve issues and to focus on the things that are challenging or difficult. Not that we expect there to be masses in that respect because your team are always very cooperative. So I'll probably stop there, but I'm happy to take any questions if there are any.
Thank you very much. And can I just say, specifically thank you for the report. It's excellent, especially around the significant risks, but also the planned response. There's a lot of information contained within that. So we'll go to questions. Would you like to come in?
Thank you, Chair. It's just a question on the materiality increase. And you say it was a slight increase, but the overall materiality rate's gone up by 20%. The performance materiality has gone up by 60%. And again 20% for clearly trivial. I understand some of the reasons for it, but the average taxpayer I think would look at the idea of and £90,000 misstatement as being clearly trivial, and it's slightly balk at that. So I'm just trying to get an idea of what is the benefit to the authority and to the taxpayer in increasing the materiality rate by that amount.
So materiality in this context, I suppose, is very much an accounting audit concept. So it's about how much error there can be in the accounts before anyone who was placing reliance on them would be misled. So it's set kind of to reflect the scale and context of the organisation and what it's doing. We have a range that we use that is standard across the industry, I guess, which is somewhere between usually 1% and 2%. You're at the higher end of that because you've got a strong control environment, because you've got solid arrangements for putting your accounts together, because you've got a good track record of getting accounts that are materially correct. We set a performance materiality level to give us as auditors the opportunity to test to a lower level so that we find things that cumulatively could be material. So we look at things in more detail, and then to give you absolute assurance, we do set a very much lower specific materiality for certain areas where there's a high degree of public interest, and actually where even performance materiality, triviality or any other measure you like wouldn't help. So for example, I wouldn't like the senior officer remuneration that's in the accounts to disclose anybody's salary wrongly, let alone by £90,000. That just wouldn't work. The way that it works is that anything that's above performance materiality, we will talk to your team about amending the accounts to reflect. Anything that's above materiality, we won't sign your accounts unless it's amended. But below that and between up to performance materiality, we'd have a discussion. In fairness, I would expect you to amend, because that is the way that you've always gone in the past. You've always wanted to amend things. Where things are below performance materiality, we will leave them as unadjusted errors as long as the total of them doesn't come to a material figure, providing that they're not indicative of a fundamental problem. And that's something that we discussed with your team at the time and then come to you. Everything that's above trivial we'll report to you so that you have sight of it. But things that are below trivial, we can report them to you if you want them. We don't, because often they are, being blunt, they're rounding differences in some of the complex accounting entries. And actually, nobody's going to take any action as a consequence of them. But we use all of those numbers, if you like, to generate kind of when we do sample testing, because we don't look at every single transaction. When we do sample testing, we use those indicators to guide us when we're calculating what the potential impact could be and whether or not we need to do further work. So I suppose the benefit you've got is if there are issues that are fundamental, regardless of what materiality looks like here, if it looked like it'd be a big problem, we'd talk to your team about doing more work.
Thank you, Chair. I think that's very helpful. I'm still not completely clear on what the benefit is of increasing the materiality rate by such a significant amount. What are we gaining from that?
I suppose your audit will be focused on the things where you've got the biggest risk of things being wrong. You're not gaining anything directly. It will drive the amount of testing that we need to do and the response we expect from you, but it doesn't fundamentally change the way that we approach our audit. And I think probably important to note that we don't only test things that are material, so our samples will be picked in the same way, and we'll include, often as your team will tell me, quite small values that we want to follow through just to make sure that everything's operating as it should. So there's no direct benefit from it. It is set in accordance with appropriate benchmarks.
I think before I come into your question, I think what you're trying to ascertain is what additional benefit are we getting from the spending of that 90,000? Is that right? We probably wouldn't be looking at that in this particular report. We're looking at how the accounts are audited and presented rather than how the money is being spent. That would be for not this particular report. Does that make sense?
Not actually what I was saying is in terms of increasing the amount at which we consider a material misstatement.
Right. Okay.
But I think the answer's pretty much been given.
Thank you. Would you like to ask a question?
Thanks, Chair. Yeah, that was helpful. That's helpful explaining some of my uncertainties. And was really just wondering how typical is that of other organisations? Is this change unusual, or just because other people do it doesn't make it right or wrong? But I'm just interested to see where we stand in all of this.
Okay. So materiality is set on a range that goes from 1% up to about 2%, typically. Rarely, if ever, exceeds 2% anywhere. That's kind of the standard industry benchmark. So we as a firm are in line with the rest of the sector. The organisations that have materiality set at the 2% end of that range are the ones that have the strongest control environments, the best arrangements in place, proper effective ledger system, controls operate effectively around the IT environment and so on. So we know that we can fundamentally place reliance on the information that comes from your systems. The organisations that have the biggest challenges in terms of operating their control environment and doing things well, if you like, will have a materiality that's set at the lower end of that range. My experience is that a lot of public sector bodies, particularly large ones, tend to be towards the end of the 2% end of that range. And the ones that are below that are often challenging us on why they're not higher. What is it we need to do so that we can get our materiality up? So I'd describe the 2% bit as the good practice end of the range, if you like, from your perspective, because it is an indicator that your arrangements work well. And we use your expenditure as the measure. So the more you spend, the higher those absolute numbers will be, because they're still based on that same percentage. And that's why it's gone up a lot, if you like, for no change in the percentage. It reflects the scale and size of your operations.
Thank you. Are there any further questions on the report in front of you before we move to the recommendation? Okay, so
sorry, Chair. So I'm just going back to my notes. So we're all on the same. You're asking about the Spain name report, aren't you? Yes.
I am, yes.
Yes, sorry, Chair. On page 19. To the risk, the defined benefit pension liability. Forgive me if I didn't understand this.
Sorry, can you put your microphone on just for the benefit of anybody listening?
Sorry.
Okay, don't worry.
On page 19, there's the question about the defined benefit pension liability. I wonder if you just could help me with possibly a little bit more plain English, if you could, please, Karen.
I'll take that one, Chair. So this is the pension for firefighters, which is an unfunded pension scheme. So it's a liability that is calculated by the Government Actuarial Department, and it's the authority's liability for the future. So it's based on our current firefighters and our retired firefighters, and based on future recruitment and retirement rates. And that's a forecast that's actually given by the Government Actuarial Department to actually put into the accounts as a liability within the accounts, and it is offset within the balance sheet by a unusable reserve.
But then you have some staff in the local government pension scheme, and so we do a similar amount of work. So the information that you put in your accounts is provided in terms of the assets and the liabilities, is provided to you by the actuaries, whose job it is to calculate those assets and liabilities. It's the Government Actuarial Department for your firefighter pension scheme, and it's nurses for the local government pension scheme. Sorry, just making sure I was in the right pension scheme there. So you rely on the information they give you. The information that you get from GAD will be broadly right, and you'll put it straight into your accounts. The information that is used in the local government pension scheme often shifts because there are changes in the value of the assets, and that impacts the value of the liability. So you might expect, when we report back to you next year, to see some adjustments in your accounts if those things are if those movements are material. But important to note that they don't affect your income and expenditure position, because there's a very, very complicated local government statutory override that overrides normal accounting practice and means that all you charge to your income and expenditure account is what you pay over as employer superann. I'm right with this, aren't I, Mike? Nod along. All you need to reflect in your income and expenditure account is what you pay over in employer superannuation, and you take out all of the increase in liability that would arise from the volatility in the stock market, in the other asset investments, and in the liability that reflects things like changes in life expectancy and so on. So that's really complicated. Really complicated. It makes my head ache all the time, which is why I'm asking Mike to nod along, because I can very easily go off track with this one. But essentially, your income and expenditure position will be fine. So the impact on council taxpayers and your financial sustainability is okay. What you will have potentially some adjustments through your balance sheet to both the asset and the liability and the reserve that don't really matter. That's fair enough, isn't it? But they are material, usually.
Thank you.
Do you want to come back?
Yeah, sorry, yeah. I think what I was really picking on, it wasn't so much the firefighters end of it, it was the Merseyside pension fund, which is obviously isn't for firefighters, it's for other staff. And you're saying that the last triennial valuation was in March 2022, presumably there's been another one by definition more recently, because it's every 3 years. And I was reading into that was concerning, that there's a lot of uncertainty because it's 3 years ago. Am I misunderstanding that? Is that the uncertainty issue?
Yeah, in terms of the valuation for the local government pension scheme, it's based on a 3-year actuarial review. And in terms of the firefighters is based on a 4-year one, just to give you some insight into that. The actuarial review is currently going through at the moment for our current scheme, and the fund is actually in surplus. So, and we expect it to continue in surplus as part of this current review. The outcome of that review is going to be found out later this year.
Can I just come back in on the end of that? So what that will do is change your employer's contribution rate going forwards, potentially, depending whether it's in surplus or it isn't, or whatever is agreed by the pension fund and the administrative bodies. And that's the bit that goes through your income and expenditure account, but the triennial valuation doesn't massively impact on what's in the bottom half of your balance sheet.
Thank you. Some excellent questions there. Any more before we move forward?
Chair, can I just make a comment? Councillor Biner here has just commented on the small font in this report, so looking forwards I will do my best to meet your accessibility reporting standards. So apologies that I didn't realise it was going to come out quite so small, so I will take that away and address it for the future.
Thank you very much. That's great. So the recommendation, which is set out on page 11 of the agenda, is that members note the updated report to the 24-25 audit strategy memorandum and the updated timing of the authority's 24-25 audit of the financial statements. Can we all agree that recommendation, please?
Agreed.
Thank you very much. And so that was a very short meeting for us today. The next Audit Committee will take place on the 24th of February 2026. Thank you for your questions, and I'll see you then.